Hello and a warm welcome to everyone. Good evening. Global markets obviously have been volatile as major central banks raised their interest rates multiple times in an attempt to tame inflation. Markets have just been really difficult for everyone, and I think we've all felt the pain of inflation. So tonight, what we've done is that we've gathered three speakers from FSM1.com. So we have Hui Shi from our research team, together with Peng Chong from the fixed income team, as well as Ron Ng, part of the advisory team from FSM. To try and help you address what we're facing today, as well as to share with you three ideas that can help you with your investing and to help you stay afloat during these challenging times. We understand the pain that investors are going through, and tonight this is what we would like to share with you. If you have any questions along the way, feel free to put them into the Q&A function, and our speakers will get back to you after our presentations. So without further ado, let me hand over the time to Hui Shi to begin tonight's session.
Hi, good evening, everyone. I'm Hui Shi from the research team. Today, with inflation and also growth headwinds on the top of mind for investors, the market has been seeing a lot of heightened volatility and also growing risk aversion. And we also understand that more and more investors have turned towards income investing as a way to reap benefits from the rise in interest rates and also to seek shelter from the market uncertainty. So today, I have some income ideas for you. I'll start off by sharing some ideas from the perspective of stocks, ETFs, and funds. And later on, my colleagues will also be sharing their ideas from another perspective. So the first idea I have will be our income focus list, which contains of our picks of stocks and ETFs that offer attractive and sustainable dividends. And my second idea will be our model DIY cash management portfolios, which aims to provide our investors with some ideas about how you can generate higher yields on your idle cash that is sitting in a bank accounts. So to start off with our income focus list, I think this will appeal to investors who are looking to generate a regular stream of dividend income. We created this list to identify stocks and ETFs under our research coverage that offer attractive and as well as sustainable dividends. So this kind of stocks, they are otherwise known as income stocks, which we define as mature companies. They are usually slower growing, but they are able to pay consistent dividends, such as the banking stocks as well as the REITs here in Singapore. And those that have made the cut on our list, they are income stocks under our coverage that offer the highest dividend yields, and they are at least trading at fair valuations, which means that we see room for share price to appreciate. So you're able to find our income focus lists on our website. You can go to our FSM1.com and hover over the research tab. And under research highlights, click on thematic portfolio and scroll down to find the income focus list. And once you've made it to the page, you will find that there are currently about 9 stocks and ETFs from our coverage universe that have made the cut into the list as shown by the screen over here. And to name some of them, we have the Singapore banking stocks such as DBS, OCBC, and UOB. So the Fed is on its most aggressive tightening campaign in decades to fight the high inflation. And since the main interest rate benchmark for SGD financial markets, which is the Singapore Overnight Rate Average, otherwise known as the SORA, the SORA generally tracks the US federal funds rate. And as such, we see an expansion in the net interest margins of the 3 local banks as the Fed continues to raise interest rates. But that being said, we also acknowledge that recession risk right now, it remains the biggest risk that the banks are facing. And a recession will definitely materially affect the bank's outlook, given the cyclical nature of the banking industry. But if you are looking for a stock that should be relatively more resilient than the banks during an economic downturn, I would like to point your attention towards a stock over here in our income focus list, which is called Keppel Infrastructure Trust. And I'll be sharing more about this stock in my next couple of slides. So Keppel Infrastructure Trust, or KIT in short, it is an infrastructure trust with about 6 billion portfolio of assets under management. So this stock, it holds a portfolio of evergreen businesses and concession assets spanning the segments of energy transition, environmental services, and also distribution and storage. Infrastructure stocks like KIT, they have proven to be resilient to inflation. In fact, its share price has been fairly stable as compared to many other stocks in the broader Singapore market. And this is because cash flows and revenues from the use of infrastructure assets are typically linked and are also protected by regulation, as well as concession agreements and also long-dated contracts that may include various forms of price adjustments to help pass on the effects of inflation to the end consumers. So for example, one of KIT's largest asset, which is called City Energy, it is the only producer and retailer of pipetown gas in Singapore, as well as a provider of green energy solutions. So this City Energy passes on fuel and electricity costs to its customers on a quarterly basis. And also, even if we do enter into a recession, people will still pay for their gas, their electricity, or their water to cook their food, heat their homes, and even take showers. So combined with a relatively stable demand for these assets during a recession, it is safe to say that infrastructure stocks, they tend to generate predictable cash flows that are not significantly exposed to economic cycles. And this also makes them more resilient in an economic downturn. And in fact, KIT is known for its track record of stable distributions. During COVID-19, back in 2020, the stock continued to pay out steady dividends, representing a distribution yield of about 7%, which is rather attractive. And so far, this year has been a busy one for KIT as it did make a number of acquisitions. Earlier this year, KIT completed the acquisition of a 49% stake in Aramco Gas Pipelines Company. If you're not familiar with Aramco, it is actually one of the largest company in the world by revenue as well as market cap. So Aramco Gas Pipelines Company, it holds a 20-year lease and leaseback agreement over the usage rights of Saudi Arabian pipeline and oil and gas company Aramco's gas pipelines network. And in return for this, it will receive a quarterly tariff for the gas products that will flow through the network. And that's also backed by a minimum volume commitment. And natural gas, it is expected to play a key role in Saudi Arabia's aim to achieve net zero emissions by 2060. And Aramco estimates that its gas production could potentially increase by more than about 50% by 2030, and that represents a compound annual growth rate amounting to about 4%. And this in turn, what this means for Keppel Infrastructure Trust is that they can receive higher revenue from the Aramco Gas Pipelines Company. And besides that, KIT also recently expanded into Europe. It now holds offshore wind assets in Sweden as well as Norway, with about 1.3 gigawatts of pipeline opportunity across Sweden as well as the UK. And the proposed acquisition of a German offshore wind farm was also announced, and this is expected to be completed in the fourth quarter of this year. And beyond its near-term resilience, there are a couple of tailwinds that appear to be supportive of KIT's long-term growth. And in particular, we think that the green infrastructure segment is expected to be a key driver of KIT's growth. Why green infrastructure? This is because green infrastructure benefits from secular tailwinds as well as the global decarbonization roadmap. And globally, there are trillions of investment dollars that will likely be directed to this segment in the years ahead as the world ramps up its decarbonization efforts. So these investments actually provide an opportunity for KIT to acquire more assets and grow its portfolio. And that also means investors can get to potentially receive more dividends in the years ahead. And also I want to point out that the outlook for wind and other renewable energy sources is actually favorable. For example, in Germany, the net power demand is expected to increase at a compound annual growth rate of about 2% from now until 2050. And can Germany actually meet this demand? First, we all know that the Russian invasion of Ukraine has reignited concerns about energy security, and that has also spurred action by many of the European governments to increase the deployment of renewables. And Germany, in fact, has been under pressure to become less dependent on Russian gas, but it plans to phase out the coal-fired power plants by 2030 and also shut its nuclear power plants by end 2022. And that has left it with few options to actually meet its energy demands. And as such, Germany has brought forward its 100% renewables target by 15 years to 2035. And it also plans to triple the pace of the capacity expansion for wind and solar. And so we see KIT's expansion into Germany and the rest of Europe as very timely, as green infrastructure assets in these markets are supported by the rising demand for power, as well as supportive government policies. And overall, we do really like the Keppel Infrastructure Trust for its resiliency during periods of high inflation, as well as during an economic downturn. And right now, we currently have a target price of 62 cents for this stock, which roughly translates to an upside potential of about 20%. And we also estimate that investors can potentially receive a forward distribution yield of 7% in the next 1 to 2 years. So other than our income focus lists as well as KIT, another idea that I want to share today will be our model DIY cash management portfolios. Even with the slump in global risk sentiment, we believe that it is still not ideal for investors to be holding too much cash, because with today's high level of inflation, holding tons of cash simply means that your holding tons of cash simply in bank accounts would mean that the real value of your savings are being eroded very quickly. And investors who are holding excess cash, we think that they should be considering instruments that can provide higher interest rates. And one way to do so is to actually create your very own cash management portfolios. So what is a cash management portfolio? It is meant to serve as an alternative to traditional bank deposits with higher yields, while still being able to provide investors with a good amount of liquidity. It mainly invests in fixed income funds, such as money market and short duration bond funds. So this kind of funds, they are of lower risk. And while cash management solutions are not difficult to find nowadays, thanks to many of the robo-advisors out there in Singapore, we think that DIY cash management portfolios offers investors like yourselves with greater flexibility, because you can choose exactly what you want to invest in based on your risk profile as well as your desired yield. The decision is entirely up to you. And besides that, creating your own cash management portfolio also means that you can potentially save on the annual management fees that is being charged by some of those robo-advisors. But the key difference between a cash management solution as well as the difference between a cash management solution and also the deposit accounts from the local banks is that the cash management portfolio is not covered under the deposit insurance scheme that is administered by the Singapore Deposit Insurance Corporation, also known as SDIC in short. And if you do want to construct your very own cash management portfolio, there are indeed a plethora of products that investors can really consider that can serve as building blocks to craft a very own portfolio. And furthermore, the funds can come in either accumulation or distribution share classes, which provides you with the option to either receive a payout or reinvest the income received back into the fund to generate additional capital growth. And when it comes to building your own cash management portfolio, investors can really follow a simple 3-step approach. So the very first step will be to select an anchor for the portfolio. What do I mean by an anchor? We define an anchor as lower risk funds, which tend to generate reasonable returns at relatively lower volatility. And what this means is that they can potentially serve as a stabilizer for the portfolio. And we think that short duration bond funds with a risk rating of 1 on our platform will fit this criteria best. And investors can consider certain funds like the Lion Global New Wealth Series, Lion Global SGD Enhanced Liquidity Fund, as well as the Nikko and Shenton Short-Term Bond Fund. After that, the second step is to add yield enhancers into your portfolio. And we define yield enhancers as funds with exposure to higher credit risk. And as the name suggests, they are included so as to provide higher yields for your overall portfolio. And you can consider products with a risk rating of 2 to 3 on our platforms. And in the current environment where inflation is expected to stay high and rate hikes could potentially be faster than expected, we would advise investors like yourself to keep a short duration exposure. So you can check out funds such as the United SGD Fund, the Lion Global Short Duration Bond Fund, and the Fidelity Enhanced Reserve Fund, which all have a short duration of less than 3 years. And besides that, you can also consider the Fullerton Lux Asian Bonds Fund in order to gain a pure play exposure to Asian investment grade bonds, whose use we think they are beginning to look more attractive. And finally, also, I want to provide a word of caution. Do try to avoid any high yield bond funds. We do know that global high yield bonds, they are offering a yield of up to 10%. They may sound indeed attractive, but we think that those are too volatile and they take on too much credit risk, and that affects their ability to play an effective role in a low risk cash management portfolio. So do try to avoid your high yield funds and high yield bond funds and stick with the investment grade bond funds. And lastly, for the final step, depending on your risk profile as well as your desired yield, you can mix and match the funds in order to form a cash management portfolio. So a conservative investor ideally should allocate the majority of the portfolio, like 80% for example, into lower risk funds, which we define as an anchor. And for investors who want to undertake more risk, they could allocate more of their capital into funds with higher credit risk, which we previously defined as a yield enhancer. Do take note that in returns for potentially higher returns, investors will also have to accept higher volatility as well as a greater risk of capital loss. And as the risk of the portfolio increases, we also suggest that you should have a greater variety of underlying products for diversification purposes. And there are also idiosyncratic risks relating to each fund manager, and hence you ideally should want to diversify across different fund managers as well. And to help investors get started here at FSM1, we have also constructed some model portfolios that I'll be sharing. So the portfolios, they were constructed with the characteristics of what we believe a cash management solution should have, which is higher yields than the bank deposits, while staying invested in fixed income funds that are on the lower end of the risk spectrum. So firstly, for a conservative portfolio, we think that the majority of the fund allocation, 80% for example, is in anchors, which can be the Nikko AM Shenton Short-Term Bond Fund. So this fund, it invests in a broadly diversified portfolio of high quality short-term bonds as well as money market instruments. And after that, we also added the United SGD Fund, which is a slightly riskier fund as compared to anchors in order to enhance the yield of the entire portfolio. So an investor with this allocation is estimated to receive a net yield of slightly over 3%. And it's also worth mentioning that the portfolio has a short duration of about 1.2 years, which makes it less sensitive to the changes in interest rates right now. And in our view, this conservative portfolio is the most risk efficient, as you can deliver modest returns at a much lower volatility despite having a lower yield. And now moving on to the moderate portfolio, we seek to have a 50-50 allocation between the anchors as well as the yield enhancers. Compared to the conservative portfolio, an additional yield enhancer was selected in order to increase diversification. And an example here will be the Fidelity Enhanced Reserve Fund, which invests in short-dated and high-quality global IG bonds to provide more stability during volatile markets, such as the ones that we're seeing today. An investor with this allocation is estimated to receive a yield of about 4%. And we think that this portfolio is actually the best of both worlds between a conservative and aggressive, because the moderate portfolio seeks to balance between returns as well as volatility. Now, finally, for an aggressive portfolio, if you're an aggressive investor, you can consider this. We also added another yield enhancer into the aggressive portfolio, which is the Fullerton Lux Funds Asian Bond Fund, which invests in debt securities issued by corporates and governments in the Asian region. And this was included so as to increase diversification and also provide opportunities for the portfolio to outperform on a total returns basis. And for this portfolio, an equal weightage has been given to all of the 4 funds. And an investor with this allocation is estimated to receive a net yield of over 4%. And we are of the view that this aggressive portfolio has greater room to outperform on a total return basis during a risk-on environment due to its higher credit risk. But in return, investors will have to accept higher volatility as well as greater risk of capital loss, especially in this current risk-off environment. So all in all, cash management portfolios, they present investors like yourself with an opportunity to generate higher yields on your idle cash. And the number of combinations are plenty due to the number of funds on our platform. And a DIY cash management portfolio certainly provides the extra flexibility to tailor it to your own unique yield requirements. And we think that the Fed is expected to keep up with rate hikes throughout the rest of this year, and the rising interest rate environment provides the underlying funds in the portfolios, especially those of a short duration, to reinvest into much higher yielding bonds. And as such, we think that investors like yourself can receive higher yields as interest rates continue to climb. But in the meantime, our model portfolios can continue to provide yields that compare well against other cash parking facilities, as shown by the chart on the screen. And yeah, with that, actually, I've come together my sharing on the income focus list as well as the cash management solutions. And with that, I'll hand the time over to my colleague, Ting Chong.
Thanks, Hui Shi. Good evening, everyone. I am Ting Chong from the iFast Fixed Income team. And for today, I'll be talking about fixed income ideas that you can consider to achieve stable income during high inflation and market volatility. So firstly, let's do a quick recap on what has happened in the market so far. So many economies around the world are facing high inflation due to supply chain bottlenecks as well as higher energy prices from the Russia and Ukraine war. So this has resulted in central banks around the world to increase its key interest rates in order to bring the prices down. And the interest rates hikes have resulted in bond yields increasing as investors require higher yields for holding the bonds. US government bond yields have reached its highest levels not seen over a decade. And over in Singapore, Singapore government bonds have also been increasing ever since the announcement of the rate hikes in the US. So as seen from the chart on the right, the Singapore government bonds are currently trading over a 3% yield, which is the highest since 2008. And over in corporate bonds in Singapore, we see underperformance in the overall bond market, with the global bond index falling by approximately 20% on a year-to-date basis. However, SGD corporates, on the other hand, were more resilient as compared to other major bond indices. So as you can see from the light blue line, it has largely been more resilient as compared to other bond indices. So with bond yields reaching its highest levels in recent times, we think investors should consider to add some bonds into their portfolio for diversification and stable income during these times of market volatility and uncertainty. So firstly, I'll touch on Singapore government bonds. So the SGS bonds are bonds that are fully backed by the Singapore government, and the bond has the strongest credit rating of AAA by major credit agencies. So the SGS bonds pay a fixed interest rate with maturities between 2 to 50 years. So for investors who wish to invest in a safe asset between 1 to 2 years, the SGS bonds are suitable as it provides more yields as compared to the SSB. And as of 4th October, the yield for the 2-year SGS bond is around 3.39%. So even though there's a fixed maturity date for the SGS bonds, investors still can sell their bonds on the secondary market. It is, however, subjected to market fluctuations in the secondary market, and the bond value may be lower than its par value, which may incur additional losses when sold before its maturity date. So we will recommend SGS bonds for investors who are able to hold a short-term SGS bond to maturity. So on the table on the right, here are some short-term SGS bonds that are maturing in less than 3 years' time. And we will recommend shorter-term SGS bonds as they are less sensitive to interest rate changes. The SSB or Singapore Savings Bonds are a special type of Singapore government securities. So it has a tenure of up to 10 years and is issued monthly. Interest rates for the SSBs are determined based on the yield to maturity of the corresponding SGS bond. So for example, the 5-year average return on the SSB should be approximately equal to the yield of the 5-year SGS bond. So one very unique feature about the SSB is that it gives investors increasing returns the longer you hold the SSB. So interest rates for the SSBs will step up every year for as long as you hold the bond. So if you look at the illustration on the right, taking August SSB rates for reference, the first year coupon is 2%, and then it increases to 2.86% in the second year, and then 3.07% in the third year, and so on and so forth. So the interest rates will increase the longer you hold the bond. So these are determined by MAS, and you can refer to the rates on their website before applying. So this step-up feature results in the total average returns of the SSB to increase each year as the next interest payment will be higher than the previous one. Another unique feature the SSB provides is the flexibility to redeem the bond at any point in time, which during the tenure of 10 years. So at any point in time, holders of the SSB can redeem their SSB and receive full principal amount, as well as the accrued interest. So the recent SSB had an average 10-year return of 3.21% per annum, which is the highest yield since its inception in 2015. So applications for this month's SSB ends on the 26th of October. So if you're interested, do apply through internet banking or ATM before that date. SSBs are suitable for investors who wish to enjoy flexibility in their investments. And there's no fixed tenor for the SSB. So investors can decide when to redeem the bond. And additionally, the SSB is not affected by secondary market trading, which ensures less volatility in the bond. So with that in mind, the lack of secondary market trading also removes the ability to earn capital appreciation in the bond when interest rates fall.
Lastly, I'll talk on treasury bills, or T-bills for short. So T-bills are short-term government securities, and they are available in short tenors of 6 months and to a year. So unlike the SGS bonds, the T-bills do not have interest payments, but are issued at discount to its face value. So upon maturity, T-bills will be redeemed at face value of 100. So investors who wish to park their cash in a safe asset for a short period of time, the SGS T-bills are suitable as it provides decent yields for only a short 6 months or 1 year period. It is also suitable for investors who are undecided and would like to weigh out the volatility and uncertainty in the markets. So as of 4th October, the cutoff yield for the latest 6-month T-bill auction was 3.32%, which is much better alternative to fixed deposits and bank deposit rates. So the SGS T-bills as well as the SGS bonds are available on FSM1, and investors who purchase these bonds on FSM will only need to pay a very attractive 0.1% processing fee. So other than Singapore government securities, investors can also look at retail bonds for stable income. So recently, Frasers Property issued a retail green bond at a coupon rate of 4.47% for 5 years. So as mentioned previously, SGD corporate bonds have shown better resiliency as compared to its USD counterparts. And it is also a good source of stable income for stable income seekers. So now I'll take a dive into Frasers and introduce its credit profile and some information on the retail green bond. So just a brief introduction on Frasers. Frasers Property Limited is a multinational real estate developer that is headquartered in Singapore. The company is listed on the SGX and has a total SGX main board and has a total assets of approximately 40.4 billion Sing dollars as of 40.3 billion as of 30th September 2022. So for its first half financial results ending on the 31st of March 2022, revenues for Frasers increased by 7.5% to 1.7 billion Sing dollars. So in the last financial year, Frasers reclassified a portfolio of industrial and logistic properties in Australia and Europe from properties held for sale to investment properties. So this resulted in a gain in its financial statements during the year prior due to this accounting change. So if we take it on an adjusted basis, if we exclude the impact from the gain on the change in use, profit before interest and tax for the first half of 2022 was 526 million as compared to 478 million in the first half of 2021. Adjusted attributable profit also saw significant growth to 158 million Sing dollars as compared to 22.5 million Sing dollars. Singapore and Australia segments saw profit before interest and tax falling due to lower contributions from divested properties in Singapore, as well as lower level of residential settlements due to the timing of the completion of development projects in Australia. However, notably, hospitality segment saw a rebound in the first half of 2022, with profits increasing to 27.9 million as compared to a loss of 38 million in the first half of 2021. So this is because Frasers benefited from the reopening and easing of travel restrictions in the UK. So stronger domestic travel resulted in higher revenue per average room, or RevPAR, and RevPAR in Europe increased from approximately 38 Sing dollars to 159 Sing dollars as reservations picked up in early first quarter of 2022 for both immediate and forward bookings. RevPAR for Asia Pacific, excluding North Asia, also picked up from 98.1 Sing dollars to 112.8 Sing dollars, and this was due to the easing of COVID-19 restrictions in Singapore. Properties in Australia still remain affected during the reported financial period. However, the reopening of Australia's borders in late February 2022 will help to bolster the rebound in hospitality in Australia. Frasers has been concentrating their efforts towards industrial and logistic properties. So I&L assets grew from 11% of its total property assets to 31% of its total property assets from a period of 2016 to 2021. And this decision to reclassify I&L properties from held for sale properties to investment properties resulted in increase in recurring income from rents. So recurring income is made up from its I&L, commercial and business parks, hospitality, and retail properties, which makes up for 87% of Frasers' total property assets. So recurring income for the first half of 2022 contributed to 90% of total profits before interest and tax. And on top of that, Frasers also property assets also provides a good mix and diversity of asset classes, not contributing to more than 1/3 of its income. We also see that Frasers have a strong pipeline for FY 2022 as well as FY 2023, and this provides good earnings visibility for the company. So Frasers is expected to deliver more than 400,000 square meters of property in the second half of 2022, and as well as an additional more than 380,000 square meters in FY 2023. So in the first half of 2022, Frasers have 2.4 billion Sing dollars in unrecognized revenues for its residential projects. And looking forward, as Frasers continues to expand within the I&L space, they have approximately 8.5 million square meters of land bank available to carry out further I&L projects in the future. Taking a look at its credit profile, Frasers' credit profile has been improving year over year. Net gearing, which is the net debt to equity, improved since FY 20 following the divestment of Frasers' stake in its Asia Retail Fund, as well as Frasers Commercial Trust and their divestments in Cross Street Exchange as well. So net gearing was 105% in FY 20, and this has improved to 69.6% in the first half of 2022. Frasers also had a high proportion of fixed rate debt of 76.2%, and the average cost of debt is low at approximately 2.3% per annum. The high proportion of fixed rate debt allows Frasers to better manage its debt in a rising interest rate environment. Additionally, interest coverage for the company is also high at 3 times. So we think Frasers' capital management is adequate, and the management have taken steps to reduce gearing as well as keeping the proportion of fixed rate debt high. We also expect Frasers to refinance some of the expiring debt as it reaches their maturity. So lastly, I'll talk a bit about the Frasers Retail Green Bond. So being a green bond, proceeds from the Frasers 4.49% retail bond will be used to refinance eligible projects based on Frasers Green Finance Framework. So this means that the funds from the bonds can be used towards financing green commercial as well as residential buildings. So as of 3rd October, the Frasers 4.49% green bond is trading at an indicative yield to maturity of 4.71% on the secondary market. So due to the lack of supply of Sing dollar retail corporate bonds, we think that this bond is attractive compared to other retail bonds in the market. If you take a look on the table on the right, it shows some retail bonds with comparable years to maturity. And we see that the Frasers Green Bond offers the highest yield to maturity among its peers. So with a strong cash flow visibility from its I&L properties, as well as an adequate credit profile with high proportion of fixed rate debt, we think that the Frasers 4.49% is attractive for those who prefer a slightly longer investing time horizon of approximately 5 years. And with that, I've come to the end of my presentation, and I'm able to share some insights on the various fixed income products available to the retail market to achieve stable income in today's volatile markets. And with that, I pass my time to my colleague, Ron.
Hey, thanks, Ting Chong, and thank you once again for joining us this evening. So after hearing about these great income-focused products, well, your next question might be, how do I buy them? So if you are new to FSM1, then you need to know that most trades on our platform has to be pre-funded, which means that you have to deposit your monies, and we give you good reasons to do so, as we do pay interest for just parking your funds with us. So if you're not too sure of what to buy yet, you can just transfer your funds into one of the cash solutions and start earning interest first. There are 2 cash solutions you can choose from. Yeah, so first one obviously would be our cash management portfolio, the Auto Sweep. The current interest yield is at 1.9% per annum. And if you're wondering how we achieve this yield, we actually buy into short duration bond and money market funds. The Auto Sweep is also seamlessly integrated into our payment methods, which means that you can make use of the monies in the account to directly pay for your investments. For example, if you wish to purchase a bond that Ting Chong shared earlier, or a REIT that Hui Shi presented on, you can purchase directly using the monies parked in your Auto Sweep account. There is absolutely no need to manually liquidate or redeem your holdings to make payments. It's also not limited to just products we shared today. You can also use Auto Sweep as payment method for unit trusts and our managed portfolios. We are also excited to have launched the Auto Sweep account for CNH. If you're unfamiliar with the renminbi, it would be interesting to know that there are 2 types of renminbi. Renminbi that is circulated within China, referred to as CNY, and renminbi that is circulated outside of China, which is the CNH. We have also planned content in November to share more details about CNH and potential investment ideas with you. So just keep a lookout for details coming soon. The second cash solution and default option is the multi-currency cash account. Unlike the Auto Sweep account, which is only available in 2 currencies for now, the multi-currency cash account gives you access to 10 currencies, including popular ones like the US dollar, Hong Kong dollar, and Malaysian ringgit. The exchange rates you see on FSM1 are also real-time, so you can make currency conversions when you happen to see attractive rates. We also raised the interest rates for Sing dollar, US dollar, and Hong Kong dollar this year. And starting 1st November, the SGD cash accounts interest rate will be revised upwards to 0.6%, the USD to 1%, and the Hong Kong dollar to 0.4%. And now, on top of investing and trading on FSM1, you can spend the money in your cash account with the digital FSM1 debit card. Besides earning higher interest rates, you can make payments on online retail platforms like Lazada and Shopee directly from your FSM1 cash account. This is especially good news for income-focused investors, and as you can now spend your dividends on online purchases without having to transfer monies back to your bank account. The debit card is a collaboration with a major payment institution that is regulated by the Monetary Authority of Singapore. It is also compatible with Google Pay, so Android users can add it to your mobile wallets to receive instant payment push notifications on your FSM1 mobile app for better security. Card security like adjusting spending limits and locking the card can also be done via the FSM1 app. We are also extending the 3.5% cashback promotion till October, subject to terms and conditions. There will also be monthly lucky draws till 31st December, where 11 lucky winners stand to win up to $1,500 worth of bonus units. Finally, there will be no subscription or annual fees that you have to pay, so you don't have to worry about contacting us to request for fee waiver. Of course, if you do need to reach out to us, here's how you can do so. If you wish to speak with our friendly client services team, you may call 6557-2853 from 8:30 to 10:30 p.m. on weekdays, except for public holidays. The helpline is also open on Saturdays from 8:30 a.m. to 12:30 p.m. If you prefer writing to us, you can email to either clienthelp@fundsupermart.com for administrative queries, or advisory@fundsupermart.com for investment-related matters. We also welcome you to visit us at our office at Raffles Place. Just reach out to us via phone or email to fix an appointment first so that we can cater time for you. We have now come to the end of our presentations. Please drop your questions in the Q&A if you have any, and we will be answering them shortly. So thank you. Back to you, John.
Thank you, Ron, and thank you, everybody, for your kind attention this evening. So I just really have, well, thank you, Ron, and thank you, everyone, for your kind attention this evening. So I just really have one announcement to make, and I'd like to highlight actually the FSM1 Research Telegram channel. So if you'd like to catch up and never miss any of our investment ideas, it would be great if you actually subscribe to our Telegram channel. So we send out a summarized version of the article, and then you can catch up on what our research analysts have been looking at and have been studying. So you'll never miss any of these opportunities which were found in the market. All right, as Ron has mentioned, the Q&A is open. Put your questions in there, and I'll just hand the time over to Hui Shi. I believe she has some answers ready for you guys. Over to Hui Shi.
Thank you, John. So I'll be taking the first question, which is asking about our views on Asian high-yield bond funds like the BlackRock fund that we've been recommending for quite some time. So for Asian high-yield, we do acknowledge that their recovery has taken longer than expected as a result of the macro challenges in China, such as the COVID-19 lockdowns, as well as most recently the mortgage boycott crisis. And while market volatility is expected to hang around for a little longer as the sector tackles the challenges, we think that government intervention will be a key near-term catalyst for a recovery in the market sentiment. And spreads of Asian high yield, they are already at a record highs, and we believe that this government support should help to alleviate some headwinds in the property sector, and that can also potentially pave way for tightening of spreads in the longer term. So if you're a long-term investor, we would think that the risk reward of Asian high yield should be attractive to you. However, we do also want to stress that diversification as well as credit selection remains very crucial, because not all developers in China, they are made the same. So for example, certain state-owned developers, they tend to have better liquidity positions, and that should help them to weather through the crisis. And not to mention that further policy support is meant to create winners in the property sector. So it's safe to say that there will certainly be losers and winners within the sector. So credit selection is very important in order to pick out the winners in the sector moving forward. And so we think that investors who are looking to bet on the recovery of Asian high yield should consider active products like our recommended BlackRock Asian High Yield Bond Fund, which has exhibited a stronger risk management as compared to peers, as well as a more resilient performance. In fact, I think year to date, the BlackRock Asian High Yield Bond Fund is actually one of the strongest performers among the peers. And the reason why BlackRock Fund has performed slightly much better as compared to peers is because of its rather defensive positioning. Its exposure to China has been decreasing over the past 1 or 2 years, and right now is at about 20% of the entire portfolio. And for its China property exposure, it utilizes a barbell approach. So on one hand, they have invested in names that have already defaulted, but they have bought the bonds at cheaper prices. So they see a potential upside after the company restructures. And on the other hand, which is more of the exposure is on names that the fund manager will believe will be able to survive through the property mortgage boycott crisis, as well as other headwinds in the property sector. And some of these developers, they also tend to be the state-owned developers who have actually a much stronger balance sheets, and the fund manager also believes that they will be able to survive through this crisis. So if you are looking on betting on the recovery of the China property sector, as well as looking for income, and you're a long-term investor, I think the BlackRock Asian High Yield Bond Fund would be something to consider. And whereas for the East Spring Fund, we realize that they do have a very large exposure to China property, and they also have face some certain issues with their credit selections. That's why the East Spring Fund did not perform as well as the BlackRock Asian High Yield Bond Fund. So if you are more aggressive, you can actually go for the East Spring Fund, since it has a more higher exposure to China property. But if you are staying on the more defensive side and you want to get a more stable income as compared to East Spring, then I think you should go for the BlackRock Asian High Yield Bond Fund. I'll hand the time over to Ting Chong. Maybe you'll answer what next question.
Yep, thanks, Risha. So we have a question asking about the HSBC 5.25% 2032 bond, or the BNP Paribas 5.25% 2032 bond as well. So for HSBC bonds, we prefer the HSBC 4.375% 2026 USD bond, or the HSBC 6.5% 2024 bonds, the Great Britain pound bonds. And this is because they have a shorter time to maturity, which may limit some volatility in the change due to the change in interest rates. This is because bond prices are inversely related to interest rate changes. So when interest rate rise, bond price will fall. So the fall in the GBP currency also allows a good entry point right now to actually consider Great Britain GBP bonds, because due to the change in exchange rates, due to the fall in exchange rates. And I think one point to note is that these bonds also have loss absorption features, which may trigger when the bank's CET1 ratio or its solvency ratio reaches a certain trigger level. So there's some risk that you should consider before buying this type of banking bonds. So yeah.
I can take the next question regarding our view on the BlackRock Tiger Bond Fund or the PIMCO Income Fund. I can't comment much on the BlackRock Tiger Bond Fund, but I do have some comments for the PIMCO Income Fund. This is a fund that has been included in our iFAST discretionary portfolio. So for this fund, I do see that it has a rather short duration of about 2 years, and that also aligns with our view that we prefer short duration bond funds right now, because all the yields on the shorter end have risen quite a fair bit, while the yields on the longer end of the curve do have some more room to move up. So at present, we prefer short duration bond funds, I think that the PIMCO Income Fund does fit this criteria. And the yield is also quite high, and we think that it has also the potential to move up even further as the Fed continues to hike interest rates.
Yeah, I think I can take the question on the Astrea. So it's one attendee asked that the Astrea is trading low and close to 5% yield now. So what's the view on it? Any pros and cons? So yeah, so I think you're talking about the Astrea 3% 18th of March 2031 bond. the Class A one. So it's I think it's trading close to 5% right now. So however, there's quite a long maturity date at 2031. Even so, there's a scheduled call date on the 18th of March 2026. So this means that the Astrea can actually call back and redeem its bonds earlier than expected. But we also must note that the balance in the reserve account must be met before Astrea can actually redeem the bonds in advance in 2026. So we do have a positive view on Astrea, and we think that its credit profile is strong. However, we should also note that these are backed by private equity funds, which may not do as well during in a time of recession. But other than that, I think Astrea-wise, in the issuer-wise, I think Astrea has a good credit profile, and we are confident. We do expect Astrea to actually call back its notes early in 2026, as the cash flows from its PE-backed assets are able to reach the total balance in their reserve accounts. So yeah, hope this able to answer your question.
I'll be taking a final question about Capital Infrastructure Trust, whether they will be affected, the rental income will be affected by exchange rate movements, and how about the interest rate risk in the current rising interest rate environment. So firstly, to answer the part about exchange rate movements, currently majority of Capital Infrastructure Trust assets are located in Singapore. They do have a couple in Australia and also venturing into Europe. And I understand that the depreciation of the euro may be a concern for investors. But currently, I think most of the rental income is still coming from Singapore. I think that the impact about exchange rate movements is still minimal, but we'll still be monitoring the exchange rate movements over in Europe, as we think that also can potentially affect the distributions that can be paid out by Keppel. And regarding interest rate risk, currently the financial position of Keppel Infrastructure Trust has been much healthier as compared to historical levels. And also the rental income, unlike the REITs, the rental income received by KIT is actually being adjusted on a quarterly basis, which is actually much more frequent as compared to the REITs, where rentals only adjust when they expire. So Keppel is still able to pass on any increase in inflation or rising interest rates to consumers. So that can help to minimize the overall impact on its distributable income. But then again, the risk highlighted by our client here is still very valid, both exchange rate and interest rate risk, but we'll still be monitoring the impact over the next couple of months as the macro environment evolves.